Hello, my name is Andy. I'm with Ninox Corporation, and today we're going to look at how to create a general ledger chart of accounts for our Ninox accounting system. Let's go ahead and log into our ERP, and this is going to bring us to our main control panel. From here, we can go into Utilities and select Chart of Accounts. This is going to give us a listing of all of our accounts. Now for this presentation today, we've created a very simple basic chart of accounts, and we want to look at all of the key considerations when setting up a chart of accounts, whether you're building one at home in your own Ninox application or using the Ninox ERP system that you see on your screen right now. So let's go ahead and set up a new account. Now there's lots of things to look at here. The first thing to remember when setting up your chart of accounts is this is not only going to be used to group and categorize financial transactions, but your chart of accounts is going to drive the format and the visual appearance of your financial statements. That's why we see two different kinds of accounts here in this row type. We have financial accounts, transactional, totaling, and grand totaling accounts. And we also have formatting accounts, headers, subheaders, and blank lines. These three options, the financial rows, track the financial information, the numeric data that makes up our accounting system. These three options on the right, these formatting options, allow us to get our financial statements to look exactly the way we want, with blank lines inserted between different sections, with headers and subheaders, making it easy for us to understand what we're looking at. We'll see more how this works a little bit later in this session. Moving on, and most importantly, we want to define our account type, and there are 5: never more and never less. On our balance sheet, we have assets, liabilities, and ownership equity. And on our income statement or profit and loss statement, we have revenue and expense. Every account, every financial account, which is a transactional, total, and grand total, is going to have an account type. For the formatting accounts, the type really doesn't matter because they're not going to be reporting numeric or financial accounting information. By clicking Inactive, we can maintain old accounts without having them pop up in account selection windows, but by default, we're going to set up active accounts. Now, it's very important that we have the account number. Not only does this tell us a little bit more about the account type, but enables us to control where on the financial statement and where in our trial balance and where in our general ledger this account is going to appear. Now, typically, it's not a rule, but it is a generally accepted accounting practice that when numbering your accounts, you would use at least 4 digits. Accounts beginning with a 1, the 1,000 accounts, are going to be our assets. Liabilities will start with the number 2. Those will be our 2,000 accounts. The 3,000 accounts are our ownership equity. So all accounts starting at the number 1,000 and ending at the count 3999, assuming we're using 4 digits, are going to be balance sheet accounts. Our 4,000 accounts are going to be revenue, and our 5,000 accounts will be expense. Therefore, all accounts with an account number greater than or equal to 4,000 and less than or equal to 5999, just by virtue of the number, we know that that's going to be a P&L or an income statement account. So let's create a new account. It's important that we not only focus on the first digit of the account number, but we use all of the digits to give us some information. This is what we call smart numbering. So I know if the first digit is a 1, as we see here, I know that this is a 1,000 account. That means it's an asset account on my balance sheet. If the second digit is a 1, I know that's a cash or a cash equivalent account. For instance, if this was a 2 or a 1,200 account, that might be current receivables. A 1,300 account might be inventory. A 1,400 account might be fixed assets or property, plant, and equipment. The last two digits simply set the sequencing as this row will appear in my financial reports. I'm going to set up account 1152, and we are going to call this Cash in Bank Miscellaneous Funds. This is going to be an asset, and as an asset on our balance sheet, it is going to, by default, have a debit balance. We're going to come back to debits and credits in a moment, but for right now, let's just assume this is going to be a debit balance account on our balance sheet. Now, one of the things that's crucially important when building our chart of accounts, and if you're designing your own accounting system in Ninox, is to give yourself as many different ways to slice and dice your financial data as possible. We know that we can look at this as one way to slice and dice our data. We can look at all revenues versus all expenses, ownership equity versus maybe net income, the difference between revenue and expense. The account type is one way for us to group or categorize accounts. But here we have another way. We have all of these different groups, and in this case, since this is a cash and bank account, I'm going to put this in the bank group, and within the group we have all of these subgroups, and I will call this cash on hand. So now I have big and small ways to slice and dice my data. I can slice it into a big chunk, all assets, or a medium-sized chunk, all banking assets, or a very small chunk, cash on hand. Cash on hand is different maybe than checking or certificates of deposit or trust accounts or interest-bearing savings accounts. So now we have three different ways, type, group, and subgroup, three different ways to bundle and look at and understand our accounting system. In addition to that fourth way, we have this smart sequencing. These are the very basics of setting up an account. Now remember, our chart of accounts does many things. First and foremost, it allows us to bundle, group, or consolidate similar transactions under one account and generate an account balance. Second of all, it allows us to drive the format and visual appearance of our primary financial statements, our balance sheet, our income statement, and our statement of cash flow. It also allows us to define whether we want very detailed, low-level, or more summarized, high-level financial reports. And that's where these two other options on the left side of the row type come into play. Here we see a transactional account. This is an account where we are going to post debits and credits based on financial activity that in one way or another impacts this cash in bank account. But we also know that we want to be able to roll these very detailed transaction and account balances up to a totaling and grand totaling level. So if we would do financial statements at the transactional level, we see each individual account. But if I want to roll that up and just see, let's say, middle level summary financial statements, I can have all of these types of accounts roll up to my total cash and cash equivalents. And this will allow me to take all of the accounts, and let's go back and look at them. We have checking operations, checking payroll, savings. We have a holding account for sales tax that we collect, and we have the cash and bank miscellaneous funds account that we just set up. These are all transactional accounts. And then we have this total account. Now you'll note that each of these transactional accounts, savings, cash and bank, all roll up to the same total account. When we look at that total account, account 1198, total cash and cash equivalents, we see all of the accounts that roll up to this summary detail. So this current account balance of $1,000 in our total cash and cash equivalents account is the sum total of accounts 1110, 1120, 1130, all of these 1100 accounts, and we know that our 1100 accounts are our cash and cash equivalents accounts. So now we have detail here and summary here. But we even want to be able to roll up to a higher level. And this is where the grand totals come into play. We have transactional accounts rolling up to totaling accounts. We have total accounts of total cash and cash equivalents. And you can see, just for my own formatting purposes, my transactional accounts are always upper and lower case. My total and grand total accounts are always in all caps. So here we have account 1198, total cash and cash equivalents. That's a total of my liquidity, my cash and cash equivalents. Here we have another totaling account, total accounts receivable. Here we have a total account of my total inventory. And then we have this grand total account, all of my assets. So let's look at that. We have an inventory account, that's a transactional account. That is summarized in a total inventory account. Here's our total inventory, that's a summary account, a totaling summary. And here are all of the transactional details that roll up to this total inventory totaling account. And then finally, in this totaling account, we roll that up to a grand total, total assets. So when we come here to total assets, we see that total assets is a grand totaling account. This consists of all three of our totals: total cash and cash equivalents, total accounts receivable, and total inventory. So we went from a very low level, a transaction account called inventory, to a mid-level totaling account called total inventory, to a high-level grand totaling account called total assets. All debit balance accounts, all appearing on our balance sheet. Our P&L accounts work exactly the same way. Here we have our 4,000 income accounts. Product sales, credit memos, miscellaneous charges, other revenue and vendor credits. These are all transactional accounts. This transactional account, by default, is going to have a credit balance. We know that it's a revenue account because our revenue accounts always begin with a 4, and we know it's a normal or regular operating revenue account because the second digit is a 1. Other non-operating or passive revenue or income, we might have a 42 or a 43 as the first two numbers of the account number. But again, this is a sales account called product sales. It is part of the income group, and within income, we have the subgroup. And since this is a product sales account, we will say that this is of the subgroup sales and product income. This product sales transactional account rolls up to our gross income account. Here's gross income, that's a totaling account. And here we see that gross income, the totaling account, is the total of sales, credit memos, miscellaneous. All of the transactional revenue accounts in the 4100 series of accounts. And this should have a default balance of credit on the P&L. This total account, when matched up with total cost of goods sold and netting out the contra account sales discounts, takes us to our grand total account, net income. Net income is total gross income minus total cost of goods sold, but we're missing one. We also want to net out the sales discount. So we'll roll that as a contra account to gross income. Since it's a reduction, it normally should be a credit balance because this is a revenue account, a 4,000 account on our P&L. But discounts reduce revenue. They are contrary to the earning of revenue. So it is going to be a contra account. Using the contra account flag right here allows us to have numbers correctly appear as positive or negative on the financial statement. Remember, there are not positive or negative numbers in double entry journal accounting. There are merely debits and credits. By virtue of which statement, the balance sheet or the P&L, on which an account appears, that will determine if a credit balance is a positive or a negative value. A credit balance in an asset would be a negative because we expect our assets to be debits. A debit balance in a liability would also be contrary because we expect our liability accounts to be credits. Assets by default are debits. Liabilities by default are credits. Ownership equity by default is a credit. On the P&L, revenue by default is a credit, and expense by default is a debit. Subtracting debits from credits gives us a positive or negative, a net income or a net loss on the P&L, and a positive or a negative valuation on the balance sheet. So when you want an account to appear as a negative, for example, discounts given is a negative, a reduction of income. Allowance for doubtful accounts is a reduction. It is contrary to accounts receivable. This allowance for loss or spoilage is a reduction of our inventory valuation. It is contrary to valuation of inventory. Therefore, it should normally have a debit balance because inventory is an asset, and assets normally have debit balances, which are positive. But because it's a contra account or contrary to the standard, it'll give us a negative, thereby deducting this loss or spoilage allowance, or the allowance for doubtful accounts, or cost of goods sold, or sales discounts given, all of which reduce the number to which they're contrary. It'll have them show up as negatives. So we'll see positive numbers for gross revenue, except for credit memos. Those will show up as a negative because it's a contra account. It's contrary to the standard being a credit. And then we'll have the debits for our cost of goods sold. This transactional account by default should be a credit because it is a revenue account, but it's contrary to the standard. So any debit balances will show up as negative. And as we know on our financial statement, we want to total up our revenue and then have a negative number, a reduction, a subtraction of the cost of goods sold. So those are the three financial accounts that we would set up in our chart of accounts. The other three options are formatting accounts: headers, subheaders, and blank lines. Let's look at a couple of examples of those and then look at how all of this comes together to enable us to create a financial statement. Here we see a header, account 1000, all caps, assets. Here we see a subheader, account 101, cash and cash equivalents. Here we see another subheader, accounts receivable. These two subheaders, accounts 1001 and 1200, are underneath the header assets. They each have their own section subtotal. Here is the subtotal for total cash and cash equivalents in this subsection. Here is the total accounts receivable for this accounts receivable section. And here is the total inventory in this inventory section. And we now know that every grand total would be a master section total. These are subsections, cash and cash equivalents, accounts receivable, inventory, that are all part of one section, the asset section. And at the bottom of the asset section, we see the grand total, total assets. Now, when looking at the chart of accounts as we are here, this doesn't really pop out, if you will. But if we go into reports and we go into accounting reports and select company and financial, chart of accounts, and we go look at it here, now it takes on a very different appearance. We can see that our blank lines are exactly that. They're a way for us to hide, just create a little bit of space between sections. Here's our grand total or grand section of assets. In gray, we have the subsections, cash and cash equivalents, accounts receivable, and inventory. Since we're not posting transactions to either the heading or subheading accounts, we don't need to see their account numbers. But if we click on it, we do know that there is an account number. It's the account number, for instance, account number 1000, that has the grand heading or the header account appearing before account 1001, the subheader or the section heading. And then finally, we have our totals, which appear in green. Here's total cash and cash equivalents, which has all of our cash and cash equivalent detail accounts. And then at the bottom of the section, this asset section, we see our grand total, total assets. And those blank lines, again, blank lines do have an account number because that's how we control where the line appears, but there's no need for an account name. It's exactly that, a completely blank line. This just allows us to create a little bit of improved visibility or readability to our financials. So we have our assets, section heading, cash and cash equivalents, subsection heading, transactional accounts rolling down to a section total, all of our section totals rolling to a grand total, and that's the entire asset section. Then we get into liabilities, and we have two sections, accounts payable and notes payable. Here are those subtotal or total summary accounts, and here is our grand total for total liabilities and owner's equity, and we know that this is the end of the balance sheet. So, by setting up account numbers, we can define the hierarchy, the order in which the rows appear in our financials, our trial balance, or our general ledger. The account names tell us what kind of activity is rolled up to the balance in this account. In our next video, we're going to talk about how to get additional detail of monthly balances, quarterly and semi-annual and annual balance as a way to dig into or get additional detail around the current account balance and our previous month-end balance. Thanks so much. I'll see you in the next video.